Banks and insurance companies are unique institutional investors because their investment activities are closely linked to the liabilities and obligations generated by their core business operations. Unlike pension funds or endowments, which primarily focus on achieving long-term investment objectives, banks and insurers must manage assets in a manner that supports balance sheet stability, regulatory compliance, and ongoing operational requirements. Their investment portfolios are designed not only to generate returns but also to maintain sufficient liquidity, preserve capital, and meet future obligations. As a result, asset allocation decisions are heavily influenced by liability characteristics, regulatory frameworks, capital requirements, and risk management considerations. Understanding these institutions requires analyzing both sides of the balance sheet rather than focusing solely on investment assets. Banks operate primarily by accepting deposits and extending loans, creating a balance sheet composed of financial assets and financial liabilities. Deposits represent a major liability, while loans, securities, and reserves constitute significant assets. The profitability of banks depends largely on the spread between interest earned on assets and interest paid on liabilities. Consequently, interest rate risk management is a critical component of bank portfolio management. Changes in market interest rates can affect both the value of assets and the cost of liabilities. Effective balance sheet management seeks to maintain profitability while ensuring adequate liquidity, capital strength, and regulatory compliance. Investment decisions therefore support broader institutional objectives rather than serving as standalone return-generating activities. Insurance companies differ from banks because their primary liabilities arise from contractual obligations to policyholders. Life insurance companies typically have long-duration liabilities associated with death benefits, annuities, and retirement products. Property and casualty insurers generally face shorter-duration liabilities linked to claims arising from insured events. The timing and predictability of these liabilities significantly influence asset allocation decisions. Life insurers often invest heavily in long-term fixed-income securities to match the duration of liabilities, while property and casualty insurers may maintain greater liquidity to satisfy uncertain claims. In both cases, investment portfolios are structured to ensure sufficient assets are available to meet future obligations while generating acceptable risk-adjusted returns. Regulation plays a particularly important role in the management of banks and insurance companies. Financial institutions operate under extensive regulatory frameworks designed to protect depositors, policyholders, and the broader financial system. Capital adequacy requirements establish minimum levels of financial strength that institutions must maintain. Liquidity regulations ensure that banks possess sufficient resources to meet withdrawal demands and funding obligations. Insurance regulations focus on solvency and the ability to satisfy policyholder claims. These regulatory requirements influence asset allocation, leverage usage, risk-taking behavior, and investment strategy. Consequently, institutional portfolio managers must balance return objectives with regulatory constraints and capital preservation considerations when constructing investment portfolios. Balance sheet management is central to both banking and insurance operations because risks arise from the interaction between assets and liabilities. One of the primary objectives is managing interest rate risk, which can affect asset values and liability costs differently. Duration analysis is commonly used to assess the sensitivity of assets and liabilities to changes in interest rates. Institutions often seek to align asset duration with liability duration to reduce net exposure. Other techniques include immunization, hedging through derivatives, and active asset liability management programs. Effective balance sheet management improves financial stability by reducing volatility in economic value and earnings while supporting the institution's ability to fulfill its obligations. Liquidity management is another essential consideration for banks and insurers. Banks must maintain sufficient liquid assets to accommodate customer withdrawals, loan commitments, and other funding needs. Insurance companies require liquidity to pay claims and operating expenses, particularly during periods of unexpected loss activity. Institutions therefore allocate portions of their portfolios to highly liquid securities such as government bonds and money market instruments. Liquidity management involves forecasting cash flows, evaluating stress scenarios, and maintaining access to funding sources. Insufficient liquidity can create operational challenges and threaten financial stability even when an institution remains solvent. Consequently, liquidity considerations significantly influence portfolio construction and risk management decisions. Credit risk management is equally important because both banks and insurers hold substantial fixed income portfolios and loan exposures. Credit deterioration can reduce asset values, impair earnings, and weaken capital positions. Institutions therefore conduct rigorous credit analysis and diversify exposures across industries, issuers, geographic regions, and credit quality categories. Regulatory capital frameworks often require higher capital charges for riskier assets, creating incentives to balance yield enhancement against credit risk. Portfolio managers must evaluate expected returns in conjunction with potential default losses and capital implications. Effective credit risk management supports long-term financial stability while enabling institutions to achieve investment objectives within acceptable risk parameters. The investment management process for banks and insurers ultimately focuses on achieving an appropriate balance among profitability, risk control, liquidity, and liability management. Asset allocation decisions cannot be evaluated independently because they directly influence the institution's overall financial position. Successful balance sheet management integrates asset liability matching, interest rate risk management, liquidity planning, regulatory compliance, and credit oversight into a comprehensive framework. For CFA candidates, understanding the investment considerations facing banks and insurers is essential because these institutions represent major participants in global capital markets. Their unique liability structures and regulatory environments demonstrate how institutional objectives shape portfolio construction, risk management practices, and long-term investment strategies.